Ladies and gentlemen, welcome to the beginning of week 3. Today, contracts known as annuities, second segment, retirement plans. I have a tremendous amount of regulation for you, impacted in a very short period of time. So if I were you, I'd listen to me real careful, because I know for more than 20 years, the areas on the retirement plans and the areas on annuities happen to be very significant for NASDAQ, and in some cases could be a test breaker. So listen carefully. Your client asks about his common stock portfolio and how it's performing. He would like to know about possibly implementing a derivative trading strategy on his underlying equity positions concerning option contracts. He would also like to know about how his bond portfolio is performing. And he said that he recently came into a lawsuit that finally has been satisfied. This lawsuit has been going on for the last 6 years. And he's proud to tell you and happy to tell you that today, after all legal fees have been established in the settlement, that he netted $250,000 from that settlement. He's looking at this income as newfound liquidity he may never find again. He's 44 years old. And he said maybe we should consider establishing some type of contractual plan, some type of annuity, and then later on some type of retirement investment vehicle so that he can start with the vision of putting away money for his children, his 3 children, his wife, and also establishing a portfolio for his retirement income that he might not ever have again. He would like to keep $150,000 of the $250,000 into a cash management account for liquidity needs. And invest $100,000 in the form of a one lump sum investment into some type of retirement plan and or annuity. He asks his financial advisor, which would be you, what type of products do you have for me today? Sit down, Mr. Johnson, I've got many. The first type of product that we hear is known as the annuity. The annuity is a contract. It's a contractual plan. The investor, 7, is known as the annuitant. Now, the issuer of these plans, the issuer of these annuities, the issuers of these contracts are not just life insurance-related companies like the Mass Mutual or New York Life. Broker-dealers issue annuities in significant and staggering volume. You just don't know about that. We have many products here aside from the almighty equity. And so the issuer of the plan is known as the broker-dealer. And the client is known as the annuitant. And the security is known as the annuity, or the contract, or the contractual plan. Now, the client is going to invest $100,000 in a lump sum investment, as opposed to dollar cost averaging or dollar averaging methods of accumulation that he could have established voluntarily. And it's a lump sum investment. And the first type of annuity that I want to share with you, types are securities, is called a fixed annuity. This is a rather simplified product. Now, the fixed annuity is called a fixed annuity because beginning at retirement, 59 and a half. Every age I give you today, every dollar amount of money I qualify, every percentage or penalty amount or contribution that I verbalize to you today is NASDAQ. And there's a lot of regulation. And so, beginning at retirement, this annuity, this contract, this investment will begin paying out to the annuitant a fixed dollar amount of money every month for 25 years. If it's a 25-year contractual plan, that will not fluctuate. That's why it's called a fixed annuity. Now, prior to retirement, the client is looking to invest money in this plan, in this annuity. And so that must mean that any age prior to the year 59 and a half is the period of time where the client is investing his capital in this investment, in this annuity, in this contract. And that must mean that that must be the period of time, Series 7, which establishes the client's cost basis. The period of time that he's investing his capital. Are you with me so far?
Yes.
The period of time that the contract pays out to the annuitant, are you with me so far? Well, the client is looking to receive the income from this investment is known as the payout period of time, Series 7, and that is beginning at 59 and a half and every month and thereafter over the remainder of the contractual term. Now, what's important about what I've just said is this. I have just identified in this investment, in this annuity, in this contract, 2 periods of time. Please listen carefully. There's the period of time when the client is buying in and investing into the contract. That period of time is the period of time prior to 59 and a half, prior to retirement. That must mean that that's the period of time that's associated with the client's cost basis. Are you with me so far?
Yes.
And then there's the period of time that the contract begins to pay out to the annuitant. And that's the period of time beginning at 59 and a half and every month then thereafter for the remainder of a 25-year contractual obligation. Are you with me so far?
Yes.
Now, the reason why that's important is because of the 7. Look at me carefully. Watch me. In the Series 7 examination, they're going to give you a transactional question, as you know. Are you with me so far?
Yes.
Concerning annuities. In that question, they're going to be concerning regulation for either the buy-in period of time or the payout period of time. There are different regulations for these two different periods of time. So the first and most important step when you look to interpret this question associated with annuities is to Series 7 identify, are they talking about the buy-in period of time or the payout period of time? Series 7, are you with me so far?
Yes.
Now, they might not use the words buy-in. They might not use the words payout. Are you with me so far?
Yes.
They might use subtle language like an age. Any age prior to 59 and a half is the period of time where the client is investing and going long an investment in the annuity. Heard me so far?
Yes.
They might use words like accumulation period. To accumulate is to go long, is to buy in. Are you with me so far?
Yes.
They might use the words like 60 years old. That's a payout period. Are you with me so far?
Yes.
Or a liquidation period where the client is pulling money out of the investment. So watch the language to identify buy-in or payout period of time. Are you with me so far?
Yes.
Back to the product known as the fixed annuity. Now, the client is investing capital into the annuity. Are you with me so far?
Yes.
This particular annuity will begin paying out to the annuitant a fixed dollar amount of money that will not fluctuate. Now, the annuity is also called a packaged security, just like mutual funds, because built into the fund, the mutual fund, or built into the annuity, there is a package or an underlying portfolio of securities that the client is technically really investing in when he invests in the annuity. Are you with me so far?
Yes.
When you invest money and buy into a mutual fund, what are you really buying into? You're buying into a portfolio of stocks built into that fund. Am I right?
Yes.
When you invest money into an annuity, fixed or variable, you're really investing money technically into an underlying portfolio, a package of securities that's built into and underlying the annuity itself. Are you with me so far?
Yes.
Now, this particular product to the annuitant, Series 7, has no investment risk. Your client is guaranteed to receive a fixed payout, call it $500 a month, just use that number as an example, and every month then thereafter, beginning at 59 and a half, over the remainder of the contractual term. He has no investment risk. But in any investment in the market, someone must bear the investment risk. Are you with me so far?
Yes.
Now, usually, it's the client, am I right?
Yes.
With its cost basis. But not here. Here, the investment risk is borne by Series 7, the issuer. They are required to guarantee the client a fixed payout that will not fluctuate beginning at 59 and a half and every month and thereafter over the remainder of the contractual term. Your client has no risk here associated with his investment and his return. Are you with me so far?
Yes.
So, that must mean that the issuer must take the client's investment capital and cost basis dollars and invest it into an underlying portfolio, are you with me so far, that generates a fixed return. So then the issuer can then in turn pay out that fixed return to the annuitant beginning at 59 and a half and every month and thereafter over the remainder of the contractual term. So the next question becomes, what must the makeup of the underlying portfolio be of securities that's built into a fixed annuity contract that can pay out to the annuitant a fixed payout beginning at retirement? The answer is real estate, mortgages, and bonds, Series 7. Only the fixed dividends and interest and rents coming from mortgages, along with the fixed interest income that bonds pay, are the fixed returns that the issuer can then guarantee and pay out to the annuitant beginning at 59 and a half and every month and thereafter that will not fluctuate. Are you with me so far? So, a couple of advantages that you should communicate to the client when you're on the phone issuing the recommendation of a buy into fixed annuities. They are recommended fixed annuities to a client who wants to establish some type of retirement portfolio, are you with me so far?
Yes.
Yet simultaneously receive a fixed payout that will not fluctuate. Clearly, the fixed annuity will serve that suitability requirement. Are you with me so far?
Yes.
Mr. Johnson, do you realize that this particular product will begin paying out to you a fixed dollar amount of money beginning at 59 and a half and every month and thereafter over the remainder of a 25-year period of time because it's a 25-year annuity? Mr. Johnson, that technically means to you, Series 7, advantage number 1, lifetime income. Isn't it feasible to assume that there is a high probability that the client can die prior to the end of the contractual obligation? I mean, if the contract doesn't begin paying out to the annuitant until he's 59 and a half, are you with me so far? Yes. And every month then thereafter for 25 years, if it's a 25-year annuity, who said he was going to live to 85 or 90 years old? And so therefore, he could die prior to the end of that contractual obligation. And so therefore, in effect, that is considered to be, to the client, lifetime income. Are you with me so far? Yes. A security, a product that pays a fixed return for life. Are you with me so far? Yes. He's getting income every month, beginning at 59 and a half, for technically the remainder of his life, without any fluctuation in that return. A fixed return. Are you with me so far? Yes. Well, there's one disadvantage. $500 a month, beginning at 59 and a half, is not going to be worth $500 5, 10, 15, or 20 years later. Any security that pays a fixed return will always experience what risk? Inflationary risk. And so therefore, this return, although fixed, is not indexed for the time value of money. And so there's a considerable erosion of that return over the longer the contract. Are you with me so far? Yes. And so you should tell him about the inflationary risk. If he's willing to take on the inflationary risk of the erosion of that return over the longer the period of time for fixed income, are you with me so far? Yes. Clearly that's the product. There's no question about it. Are you with me so far? Yes. And so that's the end of the regulations on the 7 associated with fixed annuities. But there is a lot of regulation on the 7 associated with annuities. Well, it's not in fixed. What type? Variable. Can you tell me why? Why is there so much variable, volatility, and fluctuation associated with variable annuities? And by the way, now that I'm on that question, where does the word variable come from associated with variable annuities? And why is there so much fluctuation? Can anybody answer that question?
Underlying portfolio.
Underlying portfolio doesn't say enough, Lucas.
Underlying portfolio is always fluctuating because it's invested in different stocks.
Common stocks. Because we're dealing with common stocks. And whenever you deal with common stocks, you deal with common stock price volatility, common stock price fluctuation, and that's where this word variable comes from, associated with variable annuities. Are you with me so far? Yeah. Now I want you to put your pens down. I want you to listen to me very carefully. The question now becomes, very carefully, if the makeup of the underlying portfolio of securities that's built into the variable annuity itself is made up of common stock exclusively, Series 7, as the security of type. We're dealing with common stock. That's the package. Are you with me so far?
Yes.
And common stocks represent price fluctuation and volatility. Then why would we recommend an annuity, like a variable annuity, that from 1 month to the next, beginning at payout, beginning at 59 and a half, will pay a higher or lower payout that will vary? Why would we recommend this particular product? Somewhere built into the variable annuity investment itself, associated with variable annuities, will provide a hedge with inflation that fixed annuities are clearly eroded by. And the answer lies into the performance of common stock prices during inflationary periods of time. What do we know about pure inflation? We deal with an economy that's experiencing what? Rising prices. Some of those rising prices that we talk about is not just the cost of energy and consumer products, but also rising stock prices. What do you know about rising stock prices during inflation? They move parallel. So what if it's month 1 and we're at payout, which means it's beginning to start to pay out this contract, a payout to the annuitant, and we're at retirement. Are you with me so far? Yeah. What if inflation is up that month? Well, the prices of the common stocks, which represent the portfolio that's built into and underlying the variable annuity, will be up in price. His payout that month will be higher. What if next month, during the payout period of time, inflation is lower? Well, then the stock prices that it's built into and underlying that variable annuity investment will be lower. His payout will be lower that month. For those months when the payout is lower and he's willing to accept a lower payout during lower inflation, when inflation is higher, that annuity will pay out a higher return, because common stock prices will move in a parallel movement with inflation. Are you with me so far? Yes. So therefore, we recommend this type of annuity, known as the variable annuity, when we want some type of contractual investment to establish a retirement portfolio, but yet at the same time, Series 7, an annuity that will provide a hedge with inflation that clearly fixed annuities are eroded by in their fixed returns. Are you with me so far? Yes. So what do we know? We know that from 1 month to the next, beginning at payout, this annuity could pay out a higher amount of money or a lower amount of money based upon the performance of the common stock prices, which move in a parallel move with inflation. Am I right?
Yes.
Well, that's at payout. Let's get to the point now where we start to invest money and start to begin with an investment and go long into the variable annuity. Are you with me so far?
Yes.
We talk about a client now, as I said at the beginning of today, that wanted to invest $100,000 as opposed to choosing dollar cost averaging or dollar averaging at a one lump sum cost basis capital investment amount of money. Am I right?
Yes.
$100,000. The client says, I would like to buy into this particular variable annuity. The name of this variable annuity is called a large cap blue chip variable annuity investment, made up of all large cap blue chip stocks as a security by class, which goes to industry. The energy variable annuity, all energy stocks. The biotech variable annuity, all biotech stocks. Just like biotech or the energy or the healthcare mutual fund. The name of the fund, the name of the annuity, Series 7, will determine the underlying portfolio by class, by type, straight common. Are you with me so far? Yes. So now we have a lot of similarities between variable annuities and mutual funds. And the similarities are much greater than just its name. Are you with me so far? Yes. That determine the underlying portfolio by class, which goes to industry. And of course, also the similarities extend beyond just dealing with common stock like they do in mutual funds built into variable annuities. Now, do you remember the SMA account? I'm bringing back margin because I know you forgot about it a little bit. I want you to lie to me today, so make it good. Are you with me so far?
Yes.
What was the SMA account? Can you remember?
Yes.
What does it stand for? It stands for Special Memorandum Account. And what is this account? Can you tell me?
You have excess liquidity, it opens up the account, puts the money in there.
Excess liquidity. That's not quite correct, but that's okay. I mean, you're hovering around the language, you're infusing all kinds of language, but it's not really giving to me what it really is. Didn't we say that the Special Memorandum Account was an account? Start out with what it really is. It's an account. I'll repeat this one more time to you. SMA is not excess equity. SMA is an account that is credited with excess equity. When the margin account experiences that excess equity, that money is credited to the SMA account. The SMA account is attached to the margin account. So it's a second account that we had to open up. And the opening in the made to the margin account that received the excess equity that could be transferred into either short selling power or long buying power to either buy more new stock on margin or sell more new stock short on margin. Am I right?
Yeah.
Well, when the client wants to establish an investment in a variable annuity, and we now know why, to provide a hedge with inflation that fixed annuities are clearly eroded by. So we always have to establish the suitability requirements of the product. Are you with me so far?
Yes.
And we've done that now, the hedge with inflation. The client is really investing into an account that contains the actual portfolio itself that is attached to the variable annuity investment, similar to the SMA account that you had to open up that was attached to the margin account. When your client opens up and invests money into a variable annuity, he's really investing into another account called Series 7, the separate account. The separate account is the critical key regulation associated with all variable annuities. Why? Series 7, Bullet 1, what is the definition of a separate account or the separate account? This is an account like the SMA account that is established and opened up by the broker-dealer, look at me very carefully, that is actually attached to the variable annuity that contains the actual physical portfolio of common stocks that the client is technically investing in. Are you with me so far?
Yes.
So now I'm telling you the makeup of this account. This is an account called the separate account that contains the actual portfolio of those 38 or 42 common stocks that the client is really investing in when he invests in a variable annuity. Are you with me so far?
Yes.
Now, when you bought into the mutual fund, are you with me so far?
Yes.
You bought shares, am I right?
Yes.
When you invest in a variable annuity, are you with me so far?
Yes.
To establish a long position during the buy-in period of time at the point of accumulation, which is prior to retirement, are you with me so far?
Yes.
Instead of buying shares, your client is buying Series 7 accumulation units. The proper trading terminology for the security here that the client is investing to go long is units, not shares. Now, similar to mutual funds, one accumulation unit, just like one mutual fund share, look up, owns a piece of each one of those stocks that's built into that separate account. Now, what if I told you there are 38 large cap blue chip stocks in that separate account? And that separate account is an account that is attached to the variable annuity. Are you with me so far?
Yes.
That's the account that contains the actual portfolio that the client is technically investing in when he goes long and invests money in a variable annuity. Are you with me so far?
Yes.
The client is buying units. Are you with me so far? Yes. He's looking to own as many accumulation units as he possibly can in his long position. Now, one accumulation unit, are you with me so far?
Yes.
Owns a piece of each one of those 38 stocks, just like one mutual fund share owns a piece of each one of those 38 stocks, equally and undividedly. Equally and undividedly means what? Your client buys one accumulation unit in that separate account. That separate account contains 38 large cap blue chip stocks. That one accumulation unit, just like that one mutual fund share, owns a piece of each one of those 38 stocks that's in that fund or that's in that variable annuity. Are you with me so far?
Yes.
So, the net asset value, same valuation as mutual funds known as NAV, is the valuation that we use to determine how much one accumulation unit is worth. Just like one mutual fund share. Are you with me so far? Therefore, what is the NAV per accumulation unit price known as? It is the price known as the offer price that the client pays to go long one unit in that separate account. Are you with me so far? He's looking to own as many accumulation units as he possibly can in his long position. Are you with me so far?
Yes.
And if we look at the assets, which are the dollars that are invested in that variable annuity, are you with me so far? Net of removing out the trading costs of the annuity and the expense costs, are you with me so far? And we look at the closing values of those 38 stocks every single day that is built into that separate account, which contains the actual portfolio. And we divide that by the total number of units outstanding, we get price per unit, or market price of how much the variable annuity is worth. Are you with me so far? And so the NAV per accumulation unit price is known as Series 7 Bullet 1, the offer price, which is the price that establishes Series 7 Bullet 2, the client's cost basis, to own an investment in the variable annuity. Are you with me so far? He's looking to invest money and go long in the separate account. Why? Because that's where the actual portfolio that he's technically investing in is located. Am I right?
Yes.
This is the buy-in period of time. You accumulate and go long. Am I right?
Yes.
The NAV per accumulation unit price is the valuation of how much one accumulation unit is worth. Whereby one accumulation unit represents an equal and undivided ownership in each one of those 38 stocks that's in that separate account. Therefore, one accumulation unit represents 1/38 the percentage of equity ownership. Am I right?
Yes.
It owns the same percentage, that one unit, just like that one mutual fund share, of each one of those stocks that's in that account. Am I right?
Yes.
And the NAV per accumulation unit price, known as the offer price that the client pays to go long one unit, depending upon how many units he's looking to go long and accumulate in his position, are you with me so far? Will fluctuate and move directly on a parallel basis with the performance of the separate account. Series 7, what does that mean? Look up. What happens if the client chose dollar averaging? He wants to buy 5,000 accumulation units every month. Are you with me so far?
Yes.
What happens if I told you it's month 1? Are you with me so far?
Yes.
You have an order on your books to accumulate and go long and buy the client 5,000 accumulation units at the current and prevailing NAV per accumulation unit price. Are you with me so far?
Yes.
What happens if at that particular point in time the separate account is up in price? I'm talking like NASDAQ. What does it mean for the separate account to have risen in price? It means that those 38 stocks that are in that account are up in price. Well, then the price that the client pays to go long one accumulation unit will be higher that month. What happens if next month the separate account is lower? That means the 38 stock prices that are in that account are lower in price that month. Well, then his offer price, known as the NAV per accumulation unit price, will be lower that month. So what do you know about this offer price, which is the price that the client spends to go long one unit in that account, where one unit owns a piece of the entire portfolio, that the NAV per accumulation unit price will go up and down and move parallel with the performance of the separate account. If the separate account is up in price, your offer price is higher that month. If your separate account is lower the next month, your offer price is lower that month. Are you with me so far? Because the NAV per accumulation unit price is the price that the client spends to go long one unit in that separate account. Are you with me so far? Therefore, the NAV per accumulation unit price has to move in direct correlation with the performance of the separate account. Are you with me so far?
Yes.
Because you're buying into that account. And that account and its performance is based upon the performance of the stocks prices in the portfolio that's in that account. Are you with me so far?
Yes.
And so, my client chose not dollar averaging or not dollar cost averaging, but a one lump sum method of accumulation to go long. Let me so far. Yeah. He said, look, I have 100,000 to go long. I'm keeping 150 of the 250 that I netted from the lawsuit into a cash management account to stay liquid. I am only prepared to give you $100,000 today to own an investment in this variable annuity. The client says, what is the current and prevailing NAV per accumulation unit price that I would have to spend to go long one unit in that account? $10 per accumulation unit. Are you with me so far?
Yes.
With the $100,000 cost basis investment at a cost of $10 per accumulation unit, how many units will the client go long in his long position? 10,000 accumulation units. Are you with me so far? There's the investment. There's the size of the position. You open up the account today. He sends in $100,000. He writes out a check and sends it into you, which establishes the client's cost basis. Are you with me so far? To go long 10,000 accumulation units at a cost of $10 per accumulation unit. Am I right?
Yeah.
Look at the $100,000 closely now. That is the cost basis dollars that he netted from his lawsuit. Am I right?
Yes.
Is that cost basis money to go along 10,000 accumulation units during the accumulation unit period of time after tax dollar cost basis money or pre-tax dollars?
After tax.
Right. My question is that after tax dollars or pre-tax dollars? The answer would have been based upon what I've told you, after tax dollar cost basis money, because I told you he netted $250,000 after taxes and legal fees. That's net money now, am I right?
Yes.
If he kept 150 of the 250 into a cash management account and took 100,000 of the 250 and went long 10,000 units, the money that I am explaining to you, which establishes the client's cost basis during the accumulation period of time, is after tax dollar money. Am I right?
Yes.
Now let's take a look, just as a segue for a moment, at client investment capital in the market. When clients buy securities, invest their cost basis in any investment in the market, wouldn't you say, more often than not, it's usually with after-tax dollar cost basis capital? Am I right? Yes. Does that mean you can invest and buy securities with pre-tax dollars? Sure you can. Is it, from an accounting point of view, fiscally responsible? No. Are you with me so far? Because remember, if you're investing money with pre-tax cost basis capital as the cost basis money, am I right?
Yes.
That cost basis is ultimately going to be taxed. Are you with me so far? Yes. So usually, it's more financially responsible to invest money in the market with after-tax dollars. Are you with me so far?
Yes.
Doesn't mean you can't establish a cost basis investment with pre-tax dollars. It's just not financially responsible. Well, if the cost basis that's being utilized by the investor during the accumulation of the buy-in period of time is made with after-tax dollar cost basis capital. Are you with me so far? Then I'd like to tell you what type of variable annuity the IRS calls this. 7, a non-qualified variable annuity, NON, write it down. In a non-qualified variable annuity, that is one in which the cost basis that's being used for the investment is after-tax dollars. Like my example. Are you with me so far? If this $100,000 that the client is using for the investment to go long and buy 10,000 units is after-tax dollar cost basis capital, that is a non-qualified variable annuity, NON. A non-qualified variable annuity has the cost basis that's being used for the investment to go long units as after-tax dollar cost basis capital. Are you with me so far?
Yes.
Now look at me. I have a question for you. Can you please identify the cost basis for the client investment to go long units during a buy-in period of time in order for the IRS to consider this variable annuity a qualified variable annuity? Pre-tax dollars, Series 7. If this $100,000, look closely, are dollars that has not been taxed, are you with me so far?
Yes.
And he's using that money to go along and buy 10,000 units, then that is a qualified variable annuity. Series 7, a qualified variable annuity is one in which the cost basis that's being utilized during the accumulation of the buy-in period of time is pre-tax dollars. Pre-tax dollar cost basis, qualified variable annuity. After-tax dollar cost basis, non-qualified variable annuity, and its considerable regulation are coming yet. Are you with me so far?
Yes.
So, the client goes long, 10,000 accumulation units at a cost of $10 per accumulation unit. Are you with me so far? With a $100,000 cost basis, and that investment was established when the client was 44 years old. Are you with me so far?
Yes.
Take a look at that separate account more acutely. There's something else that's being generated in the separate account. If that's where the portfolio of 38 stocks are you with me so far?
Yes.
What do common stocks usually generate? Dividend income. Are you with me so far?
Yes.
Known as investment income. Are you with me so far?
Yes.
So the two financial criteria that's built into the separate account is the actual portfolio itself, the common stocks, and the investment income that those common stocks distribute and generate out. Are you with me so far?
Yes.
Now, most variable annuities have built into their prospectus. Why did I say prospectus? Because I'm dealing with common stock related securities. Are you with me so far?
Yes.
What is called a reinvestment dividend provision. Listen carefully. That automatically take this investment income, which is the dividend income that's being generated from the portfolio built into the separate account. Look up and have that dividend income automatically reinvest into the separate account to accumulate and buy more units at the current and prevailing accumulation unit without the client have to send you any more new capital. You with me so far? He's taking that dividend income. The variable annuity itself is reinvesting that dividend income that's being generated from the common stocks in that account automatically to buy into the separate account every month. Are you with me so far?
Yes.
With a reinvestment dividend provision at the current and prevailing NAV per accumulation unit price. Are you with me so far?
Yes.
And so now, the client, I have great news for you, has been with you for many years. Obviously, from a fiduciary point of view, You must have been doing the right thing. And now he's 58 years old. And guess what? So many years later, are you with me so far?
Yes.
At 58, it's your client's 25th wedding anniversary. I absolutely love this one. Are you with me so far?
Yes.
Because ladies, I got to tell you something. We are completely different people. I got to tell you, men and women, X's and O's. Men are from Venus, women are from Mars. Did I actually reverse that? I usually do, but we're different. There's no question about it. We need one another. We can't live without one another, but there's no question that we're completely different in our makeup. And so I got to tell you that at breakfast this morning, he looked at his wife and said, honey, happy anniversary. She said, happy anniversary, honey. 25 years. Can you believe it? We lasted that long? I'm so excited. Well, he says to her, you're going to get even more excited than you think, because I've been on a waiting list for 6 months, and I finally got us into one of the most romantic restaurants in Manhattan. It took me 6 months to get in. She said, you didn't. No, I did, honey. Tonight at 8 o'clock, reservations, me and you. Happy anniversary, one if by land, two if by sea. Has anybody in this room ever been to this restaurant?
No.
It's got to be. You have been, Al? It's got to be. Have you, Gio? It has to be one of the most romantic restaurants you're ever going to go to. I'm talking about sunken-in living rooms. I'm talking about, it's absolutely beautiful. Romantic fires. It's very expensive. The food is not that good. It's $1 zillion for a toothpick. But I got to tell you something. When you talk about romance, that's where you go. There's no question about it. And so, she said, oh, I'm so excited, honey. Geez, it's 8 o'clock, huh? Jim, I'm going to have to get off early from work. I got to go to Saks. I got to get that new Pucci dress. I'm going to have to go to the vault and get my diamonds out. I'm going to have to get my nails done and my hair done. It's going to cost them $1,000 just to put her in that chair. But hey, this is what you do, and we wouldn't have it any other way. But we're different. And she says, oh, honey, are you going to be talking to your financial advisor today? Honey, you know I talk to him at least 2 or 3 times a day. Why do you ask? Because so many years ago, you did that investment, you know, that thing in the market with him. You know, for our future, she forgot what it's called, but she didn't forget that there was an investment that was made. She's referring to this retirement plan, because you're not forgetful, there's no question about it. You mean our annuity for our retirement. Oh yeah, that thing. I was just wondering, if you do speak to him today, how much we're worth, because I know you did it so many years ago, you know, for our future. Well, I got to run, honey. I'll see you at the restaurant tonight at 8 o'clock. Love you, bye. And that's the end of it. It's over. It's just all over. That's the end of it. Wouldn't have it any other way. My financial advisor, she is right. She is right. I completely forgot at 44. I gave you $100,000 in a cost basis fixed capital amount of money that I got from that lawsuit. And we went long 10,000 accumulation units at a cost of $10 per unit. Are you with me so far? Yeah. And now that I'm 58, so many years later, it would be nice if I could go to her and tell her what the current valuation of my variable annuity portfolio is worth. Well, so many years later, with the reinvestment of dividend provision, automatically every month buying you more units without you sending any more new capital other than the original $100,000 that you gave me at 44 years old, you are now accumulated 100,000 total units at an average cost of $10 per unit. How much is he worth?
$1 million.
Can't wait until she hears this. We're worth $1 million. What a present tonight. Looks like the QE2 in Nevis Four Seasons Hotel for our 25th wedding anniversary, no question about it. So how did it grow from 10,000 units to 100,000 units so many years later with the reinvestment of that dividend provision automatically? But that's the client saying, you don't need more new capital. Look at the growth of the portfolio because that dividend income that was being generated from the common stocks and put into a separate account has automatically every month with an automatic dividend reinvestment provision buying more units at the current prevailing NAV per accumulation unit price, which is the market price to own one unit in that account based upon the current portfolio's valuation. Are you with me so far?
Yes.
So that is, portfolio's value is worth about $1 million. Are you with me so far?
Yes.
Well, now, he's 59 and a half. And now he needs liquidity. Are you with me so far?
Yes.
Contacts his financial advisor and says, show me the money. What movie? What actor? Cuba Gooding. Show me the money, Jerry. Get me the big contract. He wants to start pulling money out of the contract. Are you with me so far?
Yes.
What do we know about annuities and retirement plans? These investments, Series 7, are taxed deferred to liquidation at OI. Are you with me so far?
Yes.
This is when it's going to be taxed. So the payout period of time is the period of time the client starts to pull money out of the annuity. Am I right?
Yes.
That's the period of time he's going into a liquidation mode. Am I right?
Yes.
As you'll see in a moment, we have different liquidation and payout options, but I want you to know that the bid price, which is the price that the client always receives when he liquidates, is known as 7, the NAV per annuity unit price. That's right. Every security has two prices, right? It's got a bid price and it's got an offer price. Every security, that is, except for options. That's a one-sided price, right? Yep. There's no bid and offer on options. There's only one price for an option contract. And what's that known as? Premium. Thank you. UberTV.com. Look up the bid price that the client receives per unit times however number of units that are being liquidated during the payout period of time, which begins at 59.5 and every month thereafter over the remainder of the contractual term, is known as the NAV per annuity unit price. 1 month to the next, it could be higher or lower. It will vary, just like his accumulation unit price. His offer price varied. Based on what? Based upon the performance of the separate account. Everything is tied to the stock's prices. Are you with me so far? A variable higher or lower offer price from 1 month to the next when you're buying in, or a variable higher or lower bid price from 1 month to the next. Now, what if it's month one? What if I told you the separate account has risen? Well, then his payout will be higher that month. What about next month? Separate account is lower. Payout is lower that month. Your payout will vary from 1 month to the next based upon the performance of the separate account, which is the common stock price portfolio that's in that account. Am I right?
Yes.
Are you with me so far?
Yes.
And so therefore, the NAV per annuity unit price is the payout price. It is the bid price the client receives per unit that will vary based upon the performance of the separate account. And it's the period of time, Series 7, that the client will be subject to a tax liability. Are you with me so far?
Yes.
Now, I'd like to inform you that this is month one, Mr. Johnson. And based upon your liquidation and withdrawal payout options that you're about to see in a moment, we are liquidating a certain number of units. And at the current and prevailing NAV per annuity unit price, times the number of units that are being liquidated, your first payout this month is, look at me, $1,100. Are you with me so far? Yes. And I'm about to give you that payout. You got that payout? Say yes. Yes. Good. I don't know what your payout's going to be next month. It will vary. Again, based upon the performance of the separate account. Are you with me so far? Yes. Now, what if I told you, in that $1,100 payout, Mr. Johnson, are you with me so far? Yes. The full payout is taxed. The full $1,100 is subject to a tax liability. Is this variable annuity a qualified or a non-qualified variable annuity?
Not qualified. Not qualified.
I want to tell you what just happened. Because I caught you. It's Monday, and I don't know what you're thinking, but your focus is not where it needs to be, and I'm going to tell you why. Did you think that they were going to ask you the definition of a qualified versus a non-qualified variable annuity? That's not the way NASDAQ is going to come at you. We established the definition of a qualified versus a non-qualified variable annuity, which goes to the identification of the cost basis during the buy-in period of time. Am I right? Yes. But they're not going to ask you the definition of a qualified versus a non-qualified variable annuity. Well, then how will they test your knowledge of qualified versus non-qualified variable annuities? By understanding the tax treatment of the payout during the annuity unit period of time, you must therefore know the definition of a qualified versus a non-qualified variable annuity without them asking you. Let's take a look at what just happened. What was the payout? How much? All right, in the payout, every month, in every payout every month, that will vary from 1 month to the next. There's a makeup of 3 financial criteria in that payout. First, in that payout represents, in that $1,100, the return of some of your cost basis original dollar amount of money in every payout. Are you with me so far? Yes. And investment income, are you with me so far, yes, is the third component. And what should happen if you should capture an NAV per annuity unit price that was higher than the NAV per accumulation unit price? What would that be known as? That's a capital gain, because that's the liquidation of a capital asset capturing a bid price that's higher than the offer. So, what is the third criteria that's in that payout every month? In every payout every month, there is, in part, the potential for a capital gain, the return of investment income, and the return of your cost basis. Now look up. If the full payout is taxed, are you with me so far? Yes. That means all 3 components of the payout are being taxed. Am I right? Yes. Look at component number 1. Andre, look at component number 1. That means we're even taxing that portion of the $1,100 that represents the return of some of your cost basis. Am I right? Yes. That's got to mean, are you with me so far, that it's what type of variable annuity? Qualified variable annuity. Why? Because here's what we don't have in this country. Excuse me. Here's what we do not have in this country. We do not have double taxation on cost basis. Are you with me so far? Yes. What if I told you that only in that payout every month, that part of that payout that represents investment income and potential capital gains of the $1,100 are taxed, but not that part of that payout that represents the return of some of your cost basis, then that's got to mean it's a non-qualified variable annuity, because That's got to mean that the cost basis that was used during the buy-in period of time was after-tax dollars, because we can't tax it twice. So you with me so far?
Yes.
Therefore, if the full payout is taxed during the annuity unit period of time, Series 7, it is a qualified variable annuity. If only that part of the payout during the annuity unit period of time that represents the return of investment income and capital gains are taxed, and not that part of the payout that represents the return of your cost basis original, then that means it's a non-qualified variable annuity. 7. Are you with me?
Yes.
Stay with me. This day is short. This day is powerful. Trust me. I know. Are you with me?
Yes.
I'm going after 25 questions on NASDAQ by the time today is over on first and second half, on the retirement side and on the annuity side. So if I were you, I would brace myself and increase your focus just another notch. This is week 3. Are you with me?
Yes.
Yeah. Well, we said now that the client had different methods on how he could pull his money out of the annuity. Are you with me so far?
Yes.
And he certainly had different ways that he could liquidate money out of the fund, on the mutual fund side, right? Based upon percentages or a fixed dollar amount of money for Tony G notes. Are you with me so far? Or maybe by selling a certain number of mutual fund shares every quarter or every month or every year, or the liquidation over an empirical period of time. By the time he was 60, he wanted to make sure he was flat and no longer long a mutual fund investment. Well, there's no difference here. Are you with me so far?
Yes.
And so we start to talk about the liquidation of withdrawal payout options during the annuity unit period of time, which is the payout period. Are you with me so far?
Yes.
So watch NASDAQ. Remember that question I showed you earlier of account information? Other words that they use to identify buy-in or payout period of time concerning certain regulations are accumulation period, buy-in. What if you see language like annuity period? That's payout period. Are you with me so far? Because that's the bid price you receive when you liquidate money and receive a payout, which means he's 59.5 in every month and thereafter. Well, I'm during the annuity unit period of time. Are you with me so far?
Yes.
And I'm talking about different methods as the client can pull his money out of the annuity. And you read about 4 different liquidation and withdrawal payout options during the annuity unit period of time. And they were straight life, life annuity with period certain, joint and last survivor life, and there's one payout that's not in the body of your work, and it's on the Series 7 exam, and it's called installment for a designated amount. These were payout options, just listen carefully before you write, that the annuitant can choose, are you with me so far,
Yes.
during the annuity unit period of time on ways he can pull his money out of the annuity. Are you with me so far?
Yes.
But the questions on NASDAQ are much greater. They are going to give you, Series 7, 4 transactions. Listen carefully. These transactions are associated during the annuity unit period of time between the financial advisor and the annuitant. The annuitant is going to contact the financial advisor on NASDAQ in the question, are you with me so far,
Yes.
and explain to the financial advisor certain financial liquidity needs that the annuitant has that he wants to fulfill during this annuity unit period of time from his annuity. Are you with me so far?
Yes.
He might have certain health concerns, where, as you'll see in a moment, the annuitant might not feel he would live to the end of the contractual obligation for 25 years. And he's looking to either finance educational costs for his tuition for his children from his annuity, or maybe he's looking to receive the maximum amount of money every month because he might not live to the end of the contractual obligation, or maybe he's looking to provide income to his wife to take care of his 3 children before the end of this contract or before he feels that he might die because he might have a significant health risk. There are many different types of financial investment objectives that the annuitant has during the annuity unit period of time. Once they identify Series 7 in the account information, the annuitant's financial objectives, are you with me so far?
Yes.
Then the annuitant is going to ask the financial advisor for the best recommended withdrawal payout option during the annuity unit period of time that fulfills the annuitant's financial needs. Are you with me so far?
Yes.
Then they're going to give you all 4 choices. Straight life, life annuity with period certain, installment for a designated amount, and joint and last survivor life. And they're going to ask you to act as the financial advisor on those trades and select the correct payout option that fulfills the annuitant's obligations, without them asking you the definition of the payout option. Now, if you can recommend the correct payout option that fulfills the annuitant's financial liquidity needs during the annuity unit period of time, you must therefore know the definition of the payout option and when it's recommended and where, without them asking you the definition of the payout option. Can't you see the madness that NASDAQ has? Are you with me so far?
Yes.
I'm going to give you all 4 trades right now to end these annuities. Are you ready?
Yes.
NASDAQ, bullet 1, trade 1. An annuitant contacts the financial advisor during the annuity unit period of time for the best recommended withdrawal payout option. Listen carefully. That would pay the annuitant the maximum benefits, the most amount of money during the annuity unit period of time by liquidating the most number of units. This annuitant, furthermore, is a high health risk and might not live to the end of a 25-year contractual obligation. This annuitant is not married, he has no wife, nor does he have any children without any designated beneficiary. He's solo. Are you with me so far?
Yes.
So here's the trade. We have an annuitant who's not married. He doesn't have children. He has no designated beneficiary. He's a high health risk. He does not feel medically he's going to live to the end of the contractual obligation, and he's looking for this annuity to liquidate the most number of units right now that can possibly be liquidated to pay him the most amount of money on a monthly basis. There's only one type of payout option during the annuity unit period of time that fulfills that investment objective. 7, straight life. In a straight life liquidation withdrawal payout option, it will liquidate the annuity, the most number of units on a monthly basis to pay the annuitant the maximum benefits without any designated beneficiary for an annuitant who might not live to the end of the contractual obligation. Straight life, Series 7, Bullet 1. Are you with me?
Yes.
Are you with me?
Yes.
Series 7, scenario trade number 2. We have an annuitant who contacts the account executive during the annuity unit period of time for the liquidation of units to receive the benefits from the annuity, finance educational costs of $250,000 for 2 children for 4 years. Now, 7, installment for a designated amount is the withdrawal option. It's not in your books, write it down. Installment for a designated amount liquidation and withdrawal payout option, just listen carefully to its definition, will liquidate a certain number of units from the annuitant's long accumulated position, are you with me so far,
yes,
during the annuity unit period of time, or over an installment period. The installment period is to liquidate units over 4 years to cover a fixed expense of known duration. That fixed expense we now know is $250,000. The known duration of the expense is $250,000 for 4 years to cover the expenditures of the cost of educational funding for his children. Are you with me so far? So this withdrawal option will liquidate a certain number of units over a certain installment period of time of 4 years to cover the fixed expense of $250,000 to finance 2 children for 4 years of college costs. Are you with me so far? 7, installment for a designated amount. We have Series 7 trade number 3, an annuitant during the annuity unit period of time who happens to be a grandfather. Are you with me so far? Yeah. He's concerned that prior to the end of the annuity, that this annuity would finance and take care of his son and his grandson. We have an annuitant who's a grandfather. He wants to ensure that either prior to his death or prior to the end of the contractual obligation, his son and his grandson are financially taken care of from the benefits from the annuity. There's only one type of withdrawal payout option that would have the annuitant take care of 2 people before the end of the contractual obligation, and that's called joint and last survivor life. In a joint and last survivor life liquidation withdrawal payout option during the annuity unit period of time, just look at me carefully and I'll show you how it works. A certain number of units are being liquidated first from the annuitant's total accumulated long position of his units, are you with me so far, to take care of the annuitant's son. When the son dies, the remaining number and residual units in the annuitant's long position are then to be secondarily liquidated to take care of the annuitant's grandson, which is the son's son. Are you with me so far? Yes. So we have joint and last survivor life to take care of a son and a grandson when an annuitant is a grandfather during the annuity unit period of time. Are you with me so far?
Yes.
And finally, we have an annuitant who has an investment and owns a 25-year annuity. Series 7. Listen carefully. This annuitant is married, and his wife is his designated beneficiary, and he has 4 children. Are you listening to me?
Yes.
This annuitant is a high health risk with stage 4 carcinoma. All right, I'm one for the extreme. He's got cancer, and he does not feel he's going to live to the end of this 25-year contractual obligation. And so he would like to establish with the issuer a certain period of time that says that should the annuitant die prior to the end of this period certain, previously established period of time at issuance, when he takes this contract out, that the remaining number of years to the end of this period, certain period of time that's previously established at issuance, will be payable to the designated beneficiary, which is his wife, to be able to take care of her and his 4 children. In this type of liquidation withdrawal payout option, we call it life annuity with period certain. A period certain period of time is established. I'll do the trade for you. That says again, I'll just give you its definition one more time. Should the annuitant expire prior to the end of this designated and previously established period certain period of time, the remaining number of years to the end of period certain would be payable to the designated beneficiary. Let's go back to the trade. And take a look at exactly what I mean. We have an annuitant, Mr. Johnson, who has an investment in a 25-year annuity. And he's very ill medically. Are you with me so far?
Yes.
He establishes a life annuity with 15-year period, certain period of time, of his 25-year annuity investment. Are you with me so far?
Yes.
So the period, certain period of time established at issuance is 15 years. The annuity is for 25 years. Should this annuitant die, look at me, 10 years into this 15-year period, certain period of time of his 25-year annuity investment, I ask you, how many years left remaining to the end of period certain? How many years left remaining to the end of period certain? 5 years. And so the annuitant dies prior to 15 years. He dies 10 years into this 15-year period, a certain period of time. That leaves 5 years left to the remainder of the end of period certain. His wife's going to get 5 years of payments. Are you with me so far?
Yes.
What happens if the annuitant chooses the life annuity with 15-year period certain and dies after 18 years? 3 years after this 15-year period certain period of time. Are you with me so far?
Yes.
How many years of payments does the beneficiary receive now? None. Why? Because the period, certain period of time is really for whom? The beneficiary, which is the wife. The only way the wife receives any payments, the beneficiary, is if the annuitant dies prior to the end of the period, certain period of time. Am I right?
Yes.
Well, what about the annuitant? How long does he get paid for? Should he live that long? For up to 25 years for the maturity of the contract. Even so far? Yes. He only establishes a period, certain period of time because he doesn't feel he's going to live for the 25 years. And if he should die prior to this period, certain period of time, the remaining number of years to the end of the residual period of time, a period certain, will be payable for the designated beneficiary. Are you with me so far? Yes. Different withdrawal and liquidation payout options during the annuity unit period of time that fits the annuitant's financial liquidity needs and investment profile. 7. That's the end of the annuities. Now, when you come back in 15 minutes, I'm going to light it up. And we're going to the retirement plans. And after the updated regulation and an addendum that I have for you, and I told you I would give you today, which has all the changes on NASDAQ in one spot that you need to be responsible for, so you have to be sifting through, looking at OREGs, trying to figure out what's new and where. I made it very easy for you. Then we're going to, after the retirement plans and the addendum, move into the private sector. We'll talk about 401k plans and 403b plans, pension, profit sharing, employee stock ownership, and qualified retirement plans. I got a lot of regulation for you today. I wish you would get focused. I'll see you in 15 minutes for the retirement side. Thank you very much.